Hey folks, Dan Frio here, and thank you so much for taking time to meet with me this afternoon. Did you guys see the jobs numbers? Is this crazy? Okay, so I do need participation today, folks, because we got a lot of things to talk about. We got jobs report. Look at this number right here. 900,000 jobs kind of went poof on revisions. We're going to talk about that. We're going to talk about some other things, Apple. And now, if you guys are out there buying a $1,200 phone, you better have some money invested. That's all I got to say, because the iPhone, every time I go out there, I'll buy a used or revamped one or something like that. There's no way I'm going to spend $1,100 on this stuff. So that's my take on it. So if you've spent that much money and you're spending that much money, please, you got to invest some money. Okay, so let's get over to it. Here's what the stock market's doing today, folks. Here's what I want you guys to understand. What's going on in the markets, why there can be some massive changes here quick. And I'm not, as you guys, if you follow me for years, I'm not a fear monger. I don't come out here and say, oh my God, the world's ending, housing market's going to crash, rates are going to do this. I'm just here to provide you information on a daily basis about mortgage rates, interest rates, and things like that. I'm not a financial advisor, so don't take any of this, in stride. Use it for educational and entertainment purposes. Please don't. I'm just trying to help you understand the markets. And we've made some money over the last year. The Dow Jones is up, the NASDAQ and the S&P's at record highs. Now it's time to get a little conservative, because when you get headlines like this, let's just look at the headlines that we're seeing right now. Okay, so we got job growth revision down 900,000 jobs. This has to be an increase of the unemployment rate. So that's just one piece of this. Now the traders are saying, okay, maybe the Federal Reserve is going to cut 0.5%, because if you have this dismal in numbers, what are you going to do? Worker confidence in finding new jobs basically just hit a record low. So the economy, yes, when it looks to stocks and bonds, it looks like it's doing pretty darn good. But if you really take a deep dive into the details, we can see some cracks in the foundation. So what I want to try to explain to you guys today, or at least put us in a position of, we created a portfolio about a year ago. And what I wanted to do is help people understand, how do you look at stocks? What is a stock? What's the Dow Jones? Things like that. Hopefully by now you understand, the basic concepts of what ETFs and bonds and things like that are. So here's a portfolio that we created with your help over time. And here's where they are. So we got some decent returns. If you go through here, we're pretty much all in the green except one. This one right through here, it's down 5% on us, and that's Peltier. I added that because I wanted to just track this, because I'm like, I think this and NVIDIA and some of these other things are overpriced, and that's my thought. So I'm like, okay, let's track it, because I want to see, if my recollection was accurate or not. And I think I did okay on that. I didn't buy in this position. I'm sure I hold some of these in some ETFs and things like that I hold. But overall, we've done pretty darn good. We have a return down here with Bitcoin of 120%, all the way down to something just recently, which is HACK. What's that? That's hybrid, cybersecurity ETF. So that's now up 1%. So looking pretty darn good. So what I want to talk to you guys about today is how to invest in what's going on today, because it's pretty dismal out there, folks. If you look at the headlines, and that's what we're here for, you have job growth's terrible. The traders are now saying there might be a 0.5 point cut. But here's one thing that a lot of people are missing. Potential tariff refund bill could top $1 trillion. Okay? The jobs market could do whatever. Inflation could do whatever. But if we owe back $1 trillion in tariff money, because what's happening right now is the courts are looking at this saying this could be illegal. So if it's illegal, we might have to refund $1 trillion. We're already $37 trillion in debt, so that's only going to add to that. So what happens when you would add this much debt into the system? Well, debt prices would plummet and rates would jump. Okay, so that's our concern. Now, I'm not saying it's going to happen. This is the biggest catalyst that we need to pay attention to in this market. It is right through here, and I'm going to be meticulous on this every day. Okay, so here's what I want to look at. Some investment strategies. So the big picture that we're seeing right now, job reports. We just found out there's 900,000 or whatever people that aren't really on the payroll. Tariffs, rising costs for companies and consumers can hurt manufacturing and trade. Let me make sure you guys can see this okay. Let's zoom it in a little bit. The inflation numbers. We're going to get the CPI and the PPI number this week. Okay, the PPI number is producer inflation. CPI, think of the C in the front of that, as consumer inflation. So tomorrow we're going to get producer inflation. They're expecting it to drop a little bit. During my closing bell, I'll give you my expectations of what it's going to come in at. And we're going to do the same thing with the CPI. But these numbers are going to come in. And it depends on how they come in. If they come in inflated, well, now the Fed has to look at this saying, okay, we got the producer inflation going up, consumer inflation going up, the PCE going up. All the inflation numbers that we're monitoring are going up. But then we just lost, 900,000 people in the workforce. So the jobs market, and the Federal Reserve has two mandates. There's two reasons why they were created, was inflation, aka price stability, and to keep jobs at full employment. Well, the jobs market right now, the unemployment rate is 4.3, which is full employment. Anything under 5 is full employment. But this is all the things we have to look out for. Okay, so what I want you guys to understand is what this is going to do. It's going to basically slow down the economy. Lower rates will probably get lower rates ahead, because with the jobs report that just came out, unless inflation really ticks up, they're going to say, well, we got to cut rates. So we know rates are coming down in the future. Tariffs, they're still, throwing us a curveball there. So what do we want to do? We just want to play it safe right now. Okay, so I'm not a real trader. I don't like buying stocks, selling stocks. I'm not that. I just put the money in, forget it, and look back at it, 10, 20 years from now. Hopefully that's what you guys could do. Put a little bit of money aside to kind of play with, to buy those stocks. But, the biggest advice I could give you, just put it into a fund, a good fund, and just let it sit. Okay, don't get out if the markets are crashing. Just stay. Trust me. 20 years from now, hopefully, if I'm still around, you'll call me and say, Dan, thank you. Okay, so let's dive into some of the things that we're going to look at. Okay, we want to go over this because if you're watching this video, you're not a savvy, options trader or anything. You're just kind of looking at this saying, I'd love to learn more about this. So let's kind of dive into the different options we're going to have. So what we're looking at right now is people that just basically beginners or moderate investors. So you're out there and you have a little bit of money maybe or none. But let's go through here and let's understand where we want to put that money to be safe. Okay, keep a safety net. So what I do and what most people tell you is keep 6 months of your expenses into something. In today's market, it probably wouldn't be bad to have it in your savings account or something like that, because yields on that are 3, 4, 5%. But 5, 6 years ago, if you had money in your savings account, you might have been getting an interest rate on that of like 0.05. Okay, so it really didn't behoove you to put the money in your savings account, because if you have inflation, especially at that time at 6, 7%, and you're getting no return on your money, cash sitting in the bank, you're losing value. So you need to put it somewhere, even if it's short term. So we're going to go over some of those things, how you can maybe put it into like an ETF or maybe even just a money market account or something like that to help you. But you want to keep about 20 to 30% of your money in a safe haven, something you can get to quick, and you can use that money in case, let's say the furnace breaks down or your car breaks down. All right, so let's go down. The next thing we want to get into is defensive stocks. Why? And these are everyday companies that won't see a slowdown, because what do you see in the world right now? Russia-Ukraine wars in Gaza, wars here, wars there, where we're fighting crime here on a daily basis. So you're going to see a lot of those companies doing very well, okay? As well as these companies like this. Healthcare, you still have to go to the doctors. You're still going to buy pain medication. You're still going to even buy toothpaste. Utilities, you still have to pay the electric bill and everything else. Groceries, and dividend stocks. So that's what you really want to put another little piece of your money in. So that's stability. You're not going to get rich there, but you shouldn't lose any money. Now you want to get into some growth. Add some tech and automation stocks. Why? That's the vogue today. Okay, so you don't really need to pick an individual stocks. I don't like to, because like, for example, Pelletier, if we would have bought that when I was monitoring this, I've been monitoring this for a long time, but we just bought it the earlier part of this month, and it's down 5%. Okay, so this is why, we look at some of these. I don't want a high flyer, and I don't want individual stocks. That's my preference, because when you buy an ETF, basically you're buying a basket of stocks, and that's what I had this research for us. So that's what it's going to tell you. Do the QQQ, which is basically a basket of internet and big tech stocks, or VGT, which is purely technology stocks. Okay, and I'm going to show you in another section here, how to really analyze most of these, because a lot of these are in the same sector. If you get like QQQ, well, there might be another ETF that's pretty similar, has basically the same holdings, but what we want to look at is what's the cost to hold that investment. If you're a little confused, I'll show you that here in a minute. Then we need an inflation hedge. Just as the CPI surprises higher, hold some gold or inflation protected bonds. Those are called TIPS, and I'm going to give you an idea down below to do these. A lot of people say buy Bitcoin is a hedge against inflation. I don't know why, because every time an inflation number comes in higher than expected, Bitcoin plummets. So I think it's a good investment if you really dig into Bitcoin, but you really have to understand it before you invest. And I'm not saying to invest. And again, I don't say that on this channel. I'm just trying to teach you and help you understand the markets. But if you want to buy, into these positions, you can buy ETFs. You can buy gold, it's GLD, and TIPS, it's TIP. So these are the sectors that I want you to focus in on. What you do is just basically, do a third of each one of them. Here's the allocation that we kind of came up with. And I just want to go through these with you really, really quick. And then I'll get to some of the questions that you have out there. So here's what you're going to look at. The beginner's investment strategy. So if you're looking at the stability part of this, you're going to check out SHY or BND. These are bond funds, short-term funds. They should be really stable. You shouldn't lose any money in these if you're in there 2, 3, 4 months. If you're looking for a long-term, I wouldn't do these. Maybe you would, but look at this research first. Then the next thing is defensive stocks. Okay, they're recommending 2 here, and I did through all this through AI, and it's saying Vanguard Dividend Appreciation Fund or the Consumer Staples Select Sector right through there. And here's the ticker symbols, and we're going to go over those in a second. But then you have growth and innovation. This is that area where it's NASDAQ stocks, very techie stocks, and you're going to have 2 options there, QQQ or VGT. And then inflation hedge. Probably the piece that people are doing right now is gold. You hear gold's hitting a record high every day. And then TIPS. These are Treasury protected investments. So this is a good way to buy bonds kind of in a secure investment. So here's what I want you to do. Before you do any of this, here's how you do your research. And it's kind of simple when it comes to an ETF. So here's what I want you to look at. Here's the ticker symbols with a lot of these. And then what I want you to do, one of the biggest factors I want you to look at is the expense ratio. How much does this fund charge you to manage the fund? Okay, and here's the reason why. You're going to start looking at some returns here, okay? And what you're going to see is some of these are in the same field. Let's go to QQQ and the VGT. Let's say it's particularly the same avenue or same investment asset or class. If you go over to here, you're going to see the expense ratio, QQQ 0.2. I can't really, gold is higher than that, GLD at 40. Usually you're going to see, I think an expensive ratio is like 0.15 or 0.18. Would I invest something that's taken, 0.5% of my investment for the, their management fees? No. Same thing with this. You can find better alternatives to this. So what you're going to do is you're going to look at the expense ratios, and then you're going to look at the returns 1, 3, and 5 years, or whatever you want to look at. And you want to say, okay, is this one worth this, or is this worth this, or is this worth? That's what I want you to do. If you want to go into an account, here's probably the best website that I've found to do a lot of this research is Yahoo Finance, and it's free. Okay, so you can go into this. Let's just go into XLF. This is actually a basket of financial stocks. So let me break it down for you. And there's multiple financial sectors in this, but I just want to show you what this is. So if you bought 1 share of XLF, here's actually what you're going to get with that 1 share. You're actually going to own companies in all these, or shares in all these companies right here. Yahoo Finance runs a little bit slow in my system, but you're going to own shares in Berkshire Hathaway, and you hear me talk about them all the time. JP Morgan, you hear them all the time. Visa, MasterCard, Bank of America, Wells Fargo, Goldman Sachs, Morgan Stanley, American Express, Citibank. If you want to invest in all these, well, just invest right through here, the XLF. Now, it might give you, let's see if it gives us options like other related tickers. Okay, so let's see. Okay, so let me break it down for you this way. We're going to go up through here and get the summary. I want to make sure I'm comparing apples to apples. What I want to do is get something that's very similar to XLF, so then we can go through and say, okay, is it worth it? Expense ratio, 0.08. That's cheap. Okay, let's get to the year-to-date total returns, 10%. What's its yield? 1.3%. So if this stock or this ETF didn't do anything, nothing, you'd still have 1.3% appreciation in this. So this is telling me that this stock, it's managed pretty cheap with an expense ratio of 0.08. Its year-to-date returns, pretty darn good. But you don't really know, because what are you comparing it against? Okay, so let's go over to here and go into charts, because a lot of times in the charts, what you can do is you can compare it against other pieces or other classes of this. Meaning, wonder if I would buy just Berkshire Hathaway alone or things like that. So you can actually add in these charts, you can compare it to different stocks. So saying I want to add this or compare it to, Visa or something like that, you can add it in here. I'm not going to do that with you on the show right now, but these are things that you can use Yahoo Finance for. And it's really simple. Here's another reason why I like Yahoo Finance. Guys, I got to say this, because my whole goal, I'll be honest with you, a couple of years ago, I was like, my goal is to get on CNBC. I want to show you something, and I guess I'm proud of it. I was on Yahoo Finance actually over the weekend, and right here. And they actually, August, they reached out to me and said, do you still have clients still, thinking rates are going to go to 3 or 4%, or are rates going to go to 8%? So I did some research, and I, got back to them on that. But then last week they called me, and it was like a 45-minute conversation, and they went over with me. And I just want to show you this one piece of the puzzle, because, a lot of times I'll get people comment down below like, hey, Dan, you FOMO homes, and you think everybody should own a house. No, I don't. But what I want to explain to you guys is I also don't want rates to hit 2%. So I'm going to flip over to the mortgage section just for 1 second. And here's the caption in Yahoo Finance that was in here. It says, Dan Frio, mortgage advisor of St. Charles, Illinois. He said he isn't eager to return to those times, even though he was busier, and I actually made a lot more money back in those days too. He feared that if we return back to those rates, 2% or so, nobody be able to afford a home. Because I don't care if you think the housing market's weak right now or doing whatever. I can guarantee you, if rates get down to 3-4%, the housing market is going to go crazy again. So that's the tidbit on that. So a lot of times I do use Yahoo Finance, but let's get back to our portfolio here for 1 second. But that was kind of cool when they called me, and I was like, is it really them? I thought I was getting catfished or whatever. But here's our portfolio that we created. We went through the XLF, and here's multiple ones through here. There is one particular stock in here. It's OKLO. This one's doing pretty darn good, where it's up 37%. This is a nuclear play. This is a speculative play, but if you think about it, and I'm not a proponent of buying, any individual companies, but you might want to look into nuclear power right now, because to power all this AI stuff, look at NVIDIA, look at Pelletier, look at all these companies. It's massive amounts of energy that's needed for these things. We can't produce it with wind and solar and oil and things like that. We're going to have a subsidy when it comes to the power. So look at, and that's what I'll do next week. We're going to look at some other things. If you guys have comments here that you want to make, what you would like me to dive into, I'd love to do that. So, Lewis, I don't know if you're still with me, my friend, but if you guys have any comments that you'd like to address, or just give us a thumbs up or something, I'd greatly appreciate it. Hey, Dan, if I'm in the process of buying a home from a builder and there's offering a 1% under current mortgage rates, is that a good deal at no cost to me? I will repeat, yes, sir. So here's what happens is, and we'll go over to mortgage questions. Most of the time now, when we used to get a builder quote, we used to kind of, try to, see if we can beat it in some way. The builder credits that people are getting nowadays, I mean, we're talking $10, $15, $20, $30,000. Guys, take it. And what I'm asking you is take all the credits you can get. Don't really care about the rate at the time. What you're trying to get as much money as you can. Because I had a client reach out to us this morning, and this was interesting. He said, well, I just bought a house a couple months ago, and I want to refinance because the rates I locked in, it was kind of a 3-month lock-in, and my rates kind of stink at this time. But my loan officer said I can't refinance for 6 months. Well, that is not correct. If you have an FHA loan or a VA loan, you might be stuck for 6 payments because that's some of the rules built into those systems. But if you're getting a conventional loan, or you got a conventional loan, you can actually refinance the next day. We closed a couple people, I think it might have been this month, that haven't even they closed on their construction loan a month or two ago. Then they went through us and we refinanced them because they got a rate at like 7.5 with tons of credits. But then they closed and we just reclosed them again at like 6.5. So that's the strategies I would highly suggest that you use when you're talking with the builder. So thanks a lot. Hey, Dennis, how you doing, buddy? So they're offering 5 point. That's amazing. So yes, please jump on that in a heartbeat. And, I wouldn't look back. Just take what they're giving you. And then if you even want me to look at some of the documentation, I have no problem doing that as well. I'll post up my email address up there. So if you guys need any assistance with any of this stuff, okay, let's get over to that. So that's basically, if you guys don't have any more questions on stocks, well, let's get back through it. Let's just make sure you understand it. So this is a portfolio that we created. There's a reason for every one of these. So each week when we come in here, what I'd love for you guys to do is help me create this thing. Help me monitor this thing. Tell me when it's like, okay, it might be a good time to, buy another share or things like that. What would be kind of cool to do is be able to go in here on a monthly basis and say, okay, even if we didn't do anything with the dividends and some other things, how would this portfolio grow over time? And we can actually allocate it up here saying, okay, our initial investment, we're up, it might not seem like much, $127, which is like 8 or 9%. That's a pretty good return. But, over what I'm trying to help you understand is how to really understand investing. But right now, the goal with all this news out there right now, again, we have the payroll numbers. I thought this was going to crash the markets today, one way or another. I'm like, okay, this could be really good or really bad. And if you go over to the markets, here's kind of the reaction that it did. Got the Dow Jones up 155. Let's go over to see where I'm kind of cheating on my closing bell video, but let's see where mortgage rates are. So MBSs were all over the map. We were up, then we were down about 20 something, and then we were up, and then we were down. A lot of banks came in and repriced to the worst today, even though you see the bubbles up there. We even see those bubbles when rates come out and they're worse. So we had a couple of revisions today. So if you're locked in, you're probably not getting any better of a lock right now if we've locked in the last week or so, because we had the big revision last week that we locked in almost everybody, and basically the market's been flat from there. If you watch rates on a daily basis, you'll see them tick up a little bit. Most of the time, you might only see a range of like 0.09 or something like that. So that's what we're seeing in the bond market right now. It's down 14 ticks. It could be a heck of a lot worse than that. But again, like if you go over to the stock market, so I'll take this as a day because of all the data that we got based on this. So, okay, let's keep going down through and see who we got here today. Ramsey. Hey, Ramsey, how you doing? Thanks for joining today. Hope you got to come up with a question for me. Let's get to the next one. Seeing any outliers for Earls around 5 around yes, I don't know your situation. I don't want to get in trouble on that. This is an APR, but I just quoted somebody 5.625. Hold on. I have it here somewhere. 5.625 on an Earl. And I don't know where. And actually, they were getting a credit back of like $200-300. So, who is this? Aaron. Please do me a huge favor if you don't mind. Shoot me an email. And if you don't mind, I'll give you a call as soon as we're done. If you don't want that, I can text you. I can email you back. Just email me and let me know, if I can give you a quote. Send me your mortgage statement, whatever you need. And if you give me a phone number, I'll be more than happy to call you back. If you don't, I'll just send you a video back on where we can help you with, my friend. So thank you so much for taking the time to join today, and hopefully you reach back to me. Let's see what we got. I think yes, got that. Let's go to the next one. What do we got? Our rate's $599 today. It depends on which program you have, but a lot of rates, yes, I'm going to say out there some rates, if you have a really good credit score, your loan to value is 80% or below, we are seeing some rates in that range today. But the problem is right now, right through here, MBSs are kind of taking it on the chin. They opened up the day -5. And then it deteriorated. We're now -14 right now, but it was even worse earlier in the afternoon. It was down like 20. So this is where, even in Yahoo Finance, here's what they asked me, and this was kind of intriguing. It was the last question right before we hung up the phone. The young lady said, "Dan, you've done this a long time. What's the hardest time that you've seen, and kind of the whys behind it?" And I said, honestly, it's probably now. And it's not for the lack of business. It's the changes in rates that are so massive. Here, let's go over to rates for the day. And I know this is Stock Talk Tuesday, but rates last week, at one day, well, on the 15-year, it was just the other day, the 15-year mortgage rate dropped 0.25% one day last week. in one day. That's usually to see a 0.25% reduction in rates. It might take 6 months or a year. You don't usually see it in a day. So that's where, if I try to put myself in your position, if I'm out there looking to refinance, it's like, what do I do? If you're out there looking to buy, that's even the worst dilemma, because you're like, okay, do I get into building now? Because, several years ago, here's what happened to a lot of people. They started building homes, and then rates went from, 3 to 4 to 6 to 8. And then they're like, shit, I can't buy a house now. So they couldn't have. If you're refinancing, you're in the catbird seat. Here's what I would do. And just, I'm a mortgage person, so you're going to say, Dan, obviously you're going to say this. And here's what I've done over my life of being in this house for a long time. Refinance. If the break-even point is 6 months or so, refinance. Okay, if it's exorbitant, don't do it. If you could save $200, $300, $400, I had somebody the other day. It was a jumbo loan, $1.3 million. They could save $2,300 a month, and these are people that even sign up on the RateWatch tool and things like that I've been getting back to, and they're not getting back with me. And I'm like, how do you not do that? So here, the strategy I would say is, if you can have a recoup time of 6, 7, 8 months, rates might go down next year, probably, but they might not. Okay, let's get back to where we were. Let's just, rewind back to September of last year. What happened in September of last year? Well, it was kind of a eerily similar situation that we're seeing today. We had the Fed come in saying, okay, things are okay. We're going to cut rates by 50 basis points, the biggest cut they've made in decades. What happened to rates within 4 or 5 business days? They went from 6.2 to 7.2. Where are we at today? 6.2. Okay, so here's my dilemma. And I said this at the beginning of the show, right here. Okay, so if we have to issue, I'm going to do this. What is it called? The Fed Watch tool or something like that. Let's see, National Debt Clock. I'll show you guys the National Debt Clock. And people are like, hey, Dan, you don't show this anymore. Bullshit, I show it all the time. So right through here, our national debt's at $37 trillion. Okay, so let's just go back to here and say, wonder if we have to pay back that $1 trillion. Well, we're already $37 trillion in the hole, so it's not like we can just take money out of here and say, okay, here's your money back, everybody. We're gonna have to issue more bonds. Well, let's jump over to the bond market. Okay, so let me help you understand how bonds work. Okay, I'm gonna bring up the 10-year Treasury. It's a lot easier to figure this out. Okay, so let's say, for example, there's way too much of something. So we have to issue $1 trillion in bonds. That means they're going to have to push those out into market. Somebody has to buy it. It's kind of like a house or a car. So if you have way too much of something going out there, I'm going to go to this one. This is probably going to make more sense to you. So like in 2008, everybody's like, oh, the housing market's going to get worse than 2008. We've been hearing that for 4 or 5 years now, and those guys might still be saying it. I don't know. I don't even follow them anymore. But Here's what would happen. This gives you a perfect example of this. This is the MBS market. This is mortgage bonds. Okay, how this works right through here is this is the price of the bond. As it goes down, the price of the bond, rates go up. Let me see if that's correlation of today. Where are rates today? Yeah, 0.1. See it? Okay, so that's how it works. Let me get back to all this. Let me get it organized, folks. My apologies. Okay, so here's where we're at. So when prices go down, rates go up. Okay, if you have a massive drop in price, that means rates are going to skyrocket. Well, let's go back a year ago. All right, so here's what happened. When is this? September. Okay, September 16th, that's when rates were at the lowest level that we've seen, and we're almost there. Okay, what happened right after that? Federal Reserve cut rates. Bond market crashed because more and more debt was being issued. More and more debt. The country's going into a bigger deficit. That's when it really started getting headlines. Folks, we had this deficit, or pretty darn close deficit to this, for the last 2, 3, 4, 5 years. But all of a sudden, it just became the forefront because of political reasons. Okay, so now this is what you saw. So the bond market prices crashed. Well, what happened to rates? Well, they went from 6.2 to 7.2. Okay, so now here's what we've seen. We've gone from here all the way up to here. And what you're having a lot of people do is saying, I want this. Well, folks, it might not get there, but it might. Okay, what I want to explain, though, is if this tariff thing goes through, I don't care what happens to the jobs market or the inflation. That's going to be a massive reaction in the bond market. That's all I'm saying. So if you want to, you want to wait for rates to get little bit lower, God bless you. You have the right to do so. Are they going to go? I didn't anticipate these going to 6.25 in Q3. I've been saying that rates should be about 6.5. Now, as the Fed rate cuts and we get the data and the tariff data coming in, and hopefully it comes in a little bit better, rates will continue to drop. If they don't, or tariffs are deemed illegal, I don't know what's going to happen. So that's my take on the on interest rates. So hopefully I didn't dive too far in, but my apologies if I did. So let's get to the next one. Where's your friend Rick Santelli? Hey, Claudio. I'm sure he can put. He lives. I just met with a realtor last week. They reached out to me. They were local. They reached out to me like, hey, I love your show and all this. I'm like, they're like, you want to do coffee? I'm like, sure. So I sat down. The person's like, hey, where's Rick Santelli live? And he caught me complete off guard. I'm like, who? And he's like, Rick Santelli. I'm like, oh, he actually lives. I live in St. Charles. He lives in Wayne, just probably 2-3 miles from me. Don't know where he lives. I'd love to be. If anybody knows him, I'd love to meet the guy. I think he's fascinating, and I truly admire him. So, but thanks for joining us today, Claudio. Next one we got to do GLDM, which is very affordable and expense ratio is 10. You don't have to pay gold. Perfect. GLDM. Let's look at that. So let's pull it up here. GLDM. Let's GLDM. I like Yahoo Finance. So where is my Yahoo? GLDM. You know who? Another person that came in here. He's on today. Where is he? Where is Dennis? Dennis O'Brien's on here. Fantastic. He came in with he came in with a bond trade like 2-3 years ago and killed it. And that's why I talked to him the other day. I'm like, dude, what's the bond market? So he's on here. He's out in California. He's a realtor. So if you need some help in California buying a house, he's in the feed right now. So Brian, Dennis, thanks for being on here today, bud. What do we got? Okay. GLD, what do we got here? Let's go down. Yep. Factor is 0.1. Beta is 0.4. Awesome. Yield nothing, which is fine there. See a 1-year return. So it's gold. Look at this. This is crazy. 1-year return, 44%. Let's go to a 5-year. This got to be 85%. So people, you got to invest. You got to put some money away, even if it's just $50 a month, just to get used to that pattern. But thanks, Akbar. Thanks for the post, man. This is what I'd love for you guys to participate. Let's join each other and say, okay, here's something to look at. I'm not a stock guy. I do mortgages for a living. What I want you to do is understand this. And if you're a stock broker or whatever, and if you know more about this, chime in. Love to have you. Everybody I reach out to, they're always like, nah, our compliance department doesn't allow it. So be it. Applying and got it $599 with $2,100 in fees. I'm jumping on it because my current rate is 8. This week's trend, why don't you check out me real quick? We might be able to beat that. So do me a huge favor if you would. And thanks for joining us today. Send me an email and actually just send me your loan estimate that you got from that company. Let's see if I can. And here's what I say in the slogans. We have one application, one credit pool, compare to 30 lenders. Here's what I ask you to do. If we can beat them, reach out to them first and say, I'm going to get one more quote. And so is this as good as you can do? Okay. And then they're going to say, yeah. And so send me the loan estimate. If we can beat it, here's my vow to you. If we can beat them on fee and rate, both of them, please use us as a client because you've reached out to them and gave them the opportunity to service you. And if they're going to hose you now and in the future when you go back to them again, or do you have to go out and get multiple quotes again? So I'm going to compare it to 33 lenders. So again, reach out to them, let them know. But if you would, email me your loan estimate. Be more than happy. And what I'll do is I'll do a personalized video, send it right back to you. And again, if I can't compete on the rate or the fees, God bless you. You did your homework. But if I can beat them, please, I'd love to have you as a borrower and as a client. So thanks for the post. Let's see. I'm applying. Let's got next one. Dan, you're a real. Well, thank you. Whatever. Hopefully that's good. Great. Thanks a lot. I would change GLD to GLDM. Thank you so much. And I basically what I did with that is I used ChatGPT to help me create these, and that's what I usually do. Me personally, what I would do is I'd go through each one of these options and figure out, okay, if I want gold, I'd go, here's what I do. Go to ChatGPT, write in gold ETFs. It's going to give you 3, 4, 5 of them. Go into Yahoo Finance, pull them all up and say, or you can even ask ChatGPT. Let's do that. Here, let's do it. If you guys don't mind, I'm going to show you how to use AI to your advantage. Because why pay a broker? Why pay people fees for all this stuff? So let's go to ChatGPT. You can use Gemini. My son loves Gemini, but let's look. Find me 5 alternative investments to, bam. Okay, so this is what we're going to do. You're going to click that. Now, this is going to find it. Okay, and it's going to give us some other things down here. Okay, so here's what I want to do. Here it is. It actually did it for me. Okay, so here's how this works. They should be very similar. And if you go down through here, it's going to tell you which each one is. Why consider it? GLD is the largest and oldest physical gold ETF. So that's GLD. iShares Gold Trust. Okay. iShare Gold's micro. Physical gold. Okay, so here's where we're going to go down. And let's see if we can find out. Okay. Provide 1 year, 3 and 5 year return on equity. Let's see what this tells us. So what we want to do, we want to compare the costs. We also want to compare how the fund's doing. So then what I'm going to do is list the ETF on the left and the expense ratio and ROA information on the right. Click it. This is what I do even when I invest. So here's what we're going to look at. Okay, so these should mostly be similar. Let's see what we got. It didn't understand what I was saying. There it goes. So here's what we're going to do. And thank you, Akbar, for this. So here's what I was saying, and this is a perfect example. Okay, so we have, here's the funds that you can pick from, all right? So we go through here. I said GLD, which probably was almost one of the worst ones up there. And thanks to Akbar, he helped us find that out. So, well, not as bad as this one. Well, here it is. GLD, 0.4. Okay, the expense ratio, almost 0.5%. GLDM, 0.5. If you go down to here, IAUM, 0.9. Okay, so but you don't want to stop there. You want to really know what it is and things like that. So let's get to the returns. This one's return 36. They're all returning 36. They're all returning 25. They're all returning 12. Okay, so we got the same returns and completely different fee structure. So why would you pay somebody 0.5% every year to manage your money when you can pay somebody virtually nothing? So that's a fantastic way to look at this. And this is also the exact way we do mortgages. Okay, I'll relate this to this. So here's an example. Here's by using our services. This is a great roll in. So this is what we do. We pull all these up. You call Citibank. You call Bank of America. You Rocket Mortgage. You call whoever, Gold or whoever. Here's what they're going to give you. Here's what we can offer you. Okay, it's 8. You don't know because you don't know all these other ones. This is what we do behind the scenes. Okay, if you want to learn how we do this in the mortgage business, join me and Alan live tomorrow because we have a show coming out tomorrow where we show you how, if you join us tomorrow, give us your credit scores, give us your information. We're going to run it live and show you how with one credit criteria for a person, we're going to have 30 different quotes from different lenders. And it looks like this. You're going to say, well, why would you take this one when we can get this one at half the price? And folks, I am as cheap as you probably are. So this is how I invest, and this is how I work for you. So if you're out there, looking to buy or refinance, I'd love to help. I'll give you my information here in a minute, but I do want to answer the rest of the questions. If you guys are grateful enough to join me today, I make sure I answer every question that you have. If you can come in with no money and are at 20%, if you are able to save 5 to 8 years, is it worth refinancing? Yeah, I would say. It's not costing you anything. Here's the only thing. Make sure, and this is what we're doing, and we're going to talk about this tomorrow. If you're at like the person right behind before you, I think they said they were like an 8% rate. Before you go back to a 30-year term, why don't you look at a 20-year term, 25-year term? You might be able to get, okay, you're closed and your current mortgage rate is 7.5. Let's say we can put you at a 20-year at 5.99 with the same payment. You're going to save 10 years. Think how much principal every payment that you make would go to or every part of your payment go to principal versus interest. It's just little things like that we can help you with. So let me get over to who I am and what I do. So folks, my name is Dan Frio. I'm not a stock advisor. I'm not a stock trader. I'm not any of this stuff. Basically, here's what I am. I'm actually a mortgage loan advisor. I'm licensed in all 50 states as well as Puerto Rico. I had a young man watch the other day, and he's like, dude, you're in Puerto Rico. And he just put in his application today, and we're able to help him. If you're in need of help looking to buy or refinance, I'd love to be able to help you. We do have a slogan here. It's one application, one credit pool. We're going to compare your loan over 30 different lenders. How do we do that? Please join us live tomorrow. I do post those every week on our live event. So if you go to my live playlist, last Wednesday we did it. The Wednesday before that we did it. The Wednesday before that we did it. So check out how that works. So if you're looking for a quote or see it live, just join us Wednesdays. We're live. We're going to plug in your information. You're going to see how we compare your loan with over 30 different lenders, and it's amazing how it's kind of like these fees over through here. You're going to get one lender that their fees are up through here, and we're down here, and people ask, how do you do that? Well, maybe we're just a little bit more efficient, or maybe we don't have that high of a profit margin. Could be many, many reasons behind that. But if you do need some help, when it does come to a mortgage, I'd love to be able to help you folks. So reach out to us at therateupdate.com. I don't know where it went again, but you can reach me at therateupdate.com right through here. If you're looking to buy, please check out this. It's $7,000. Now, here's where this comes into major play. A lot of people have gotten down payment assistance programs or loans when they bought their house. They're like, and I don't blame you, because if you're buying $400,000 home and somebody can give you, $5,000, $10,000, $20,000 in assistance to buy a house, most people are like, shit, I'll worry about it, down the road. Well, what's happening now is a lot of people were at 7.75%, 8% rates, and now they took that down payment assistance loan, and now they can't refinance. And it's not because your house price dropped. Let's say it this way. If you were a first-time home buyer and you bought a $300,000 home, you need 3% down. Okay, that's $9,000. Okay, that would put you at 100% financing on your home. Well, let's say you got a $20,000 grant. So now you owe $291,000 plus $20,000. You owe more than your house is worth. You can't refinance. And that's what a lot of people are facing right now. So make sure when you're getting a down payment assistance loan or program, it's forgivable. You don't have to pay it, and it's, you walk out of the closing and it's not a lien on your property. If you're in the dilemma, like, I don't know when to refinance, if it makes sense, click our refinance tab right through here. What you're going to do is click it. Basically, what you're doing is you're telling me, and this goes directly to me, folks. We don't sell the data or anything. This goes directly to me, and I monitor it. Every day I'm reaching out to 10, 20 different people saying, hey, man, your rate trigger, your RateWatch trigger just triggered. And here's what it does. Basically, you're telling me, you're like, okay, Dan, my rate is, 8%, and I owe this, and here's my address and everything else. What I'm going to do, you're going to tell me what rate you want me to call you and see if it, refinance makes sense. So let's say you're 7.5. Well, you should have been calling me by now because rates are 6.25. So it's over 1% lower than you're at now. But what I'd suggest you do is, if you're just like, I don't know, put in there 1% lower than where you are now. And that, so then what will happen is it'll trigger me, and I'll reach out to you, and we'll kick around the numbers. If it makes sense, we'll get the paperwork started and lock you in. If it doesn't, we'll just keep you on the list and wait for rates to drop even lower. But finally, let's say you went out there and you did what everybody tells you to do. Go out there and get 100 different quotes. Make sure you're getting the lowest rate. Well, first, you're going to drive yourself crazy. You can't put in 100 applications, have your credit pulled 100 times, and so forth. So this is why we offer this opportunity right through here. So if you already have a loan estimate out there, please, like I said, get that. Ask that person that question. Can you do any better than this? And then upload it right through here. I'll review it, send a personalized email back to you. And again, if we can beat them on the rate and the fee, I'm hoping to win you as a client. So that's our report for today, folks. Hopefully you learned a little bit about something, not the national debt, but how a lot of this stuff, especially the tariffs, are going to play a major role in what the stocks, bonds, and cryptocurrency does. But finally, folks, if you're out there buying $1,000 phone, I don't know why, but you should have a savings account. That's all I ask. Well, that is my report for today, folks. I greatly appreciate you joining me each Wednesday for this. So if you want to figure out how we compare your loan to over 30 different lenders tomorrow, please join me and Alan. We will have a live event tomorrow afternoon. So if you want to join us then, I'd be thankful. Other than that,